Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Our focus today is squarely on the extraordinary volatility we've just seen with ANGH Inc., that's ANGH, after a strategic partnership that really just shifts its entire future. We're going to be dissecting the violent price surge that was triggered by the finalization of their deal with Warner Bros. Discovery.
And violent surge is, well, it's the right term. I mean, we were talking about a stock that in just one after-hour session, this was December 30th, it rocketed by nearly 63%. It went from the $2.30 range, straight past $3.50. This wasn't just market noise. It happened on volume that was, something like 36 times the daily average. It signals a really profound and immediate reaction.
And that exceptional volume, it validates the catalyst itself, right? The $57 million investment from Warner Bros. Discovery, WBD, into ANGH subsidiary, OSN Streaming. So the central tension here is, well, it's pretty simple. Does this huge price move represent a fundamental permanent repricing based on real strategic value? Or is it just a fragile mechanical spike that's masking some deep financial risks still hiding in the company's structure?
And I maintain that while the strategic move is, it's undeniably positive for the business itself, the sustainability of this share price surge is highly, highly questionable. To me, it looks like a mechanical reaction in a very thin market, not a reflection of sustained institutional confidence.
See, I'm going to take the opposing view. I'll argue that the WBD deal doesn't just secure short-term cash, it actually establishes a new, much higher valuation floor, and it fundamentally de-risks the company's long-term viability in what is a fiercely competitive MENA market.
And I'm going to focus on the fact that no strategic partnership, no matter how good, can just nullify the massive, ongoing cash burn, the substantial dilution risk that's coming, and the structural weaknesses that are just baked into this kind of low-float stock.
Okay, so to establish my position, we have to look at the math of the transaction itself. WBD acquired, roughly a 30% stake in the OSN streaming subsidiary, and they did it for $57 million. Now, that single private market deal implies a valuation for the entire subsidiary of about $190 million. And this is crucial because before this surge, ANGH's entire public market cap was hovering around just $16.3 million.
The valuation gap is shocking, I'll concede that. It's nearly 10 times the pre-search public valuation.
Exactly. A nearly tenfold discrepancy between how the public market was pricing the company and how, a sophisticated strategic player like WBD valued a huge piece of its core business. And what's more, the operational success validates WBD's investment thesis. ANGH's first half 2025 financials show 97% year-over-year revenue growth, hitting 48.4 million, and a doubling of their paid subscribers to 3.54 million. This just confirms that the double play strategy, the convergence of music and premium video in the Middle East and North Africa, is actually working.
Those operational numbers, 97% growth, doubled subscribers, they are certainly impressive. No argument there. However, we have to ground this discussion in solvency. My position is that this price action is a mechanical spike, and it's masking severe financial risks. We simply cannot ignore the fact that the company reported a substantial net loss of $37.1 million in the first half of 2025 alone.
That loss is substantial, yes, but you have to view it in context. It's the cost of growth.
I just disagree that WBD's investment entirely solves the fundamental solvency problem. Look, the $57 million injection provides a necessary runway of capital, but it's finite. That high burn rate means the runway will expire, and it's going to force the issue of free cash flow neutrality right back onto the table, and very quickly. More critically, the capital raise came with a looming threat, the dilution risk from that outstanding convertible note program with the OSN Group. That allows for the potential issuance of 22 million new shares at a strike price of $2.50. This risk creates an almost mathematical ceiling, effectively capping the price, despite any strategic upside.
Let's focus on that incredible valuation dichotomy for a minute, because I think understanding why WBD paid such a premium is really the key to figuring out the stock's intrinsic value. You acknowledge the $190 million implied valuation is just a data point, but I see it as the enterprise value floor. This valuation is a direct consequence of WBD's own strategic risk mitigation.
How so? I mean, they could have just launched Max on their own.
They could have, sure, but at what cost? WBD is avoiding the hundreds of millions it would take not just to launch a standalone streaming service from scratch in the MENA region, but also the years of intense effort it would take to get to a critical scale. Instead, they bought access to ANGH's existing 120 million user base and, critically, their proprietary operational infrastructure. And specifically, I'm talking about direct carrier billing, or DCB.
DCB. Right, direct carrier billing? That's probably a term we should define.
Precisely. DCB is ANGH's payment mode. In the MENA region, credit card penetration is low, but mobile penetration is near 100%. So DCB lets users pay for subscriptions right through their mobile phone bills. This payment system is notoriously difficult and time-consuming for international companies to replicate. So WBD is paying $57 million for a massive operational shortcut and exclusive access to that payment mode and ANGH's established subscriber base for premium content like HBO and Max Originals. That strategic value accrues directly to ANGH, and it justifies a much higher valuation.
I accept the rationale for WBD's high valuation. I mean, they secured exclusive rights, they locked out competitors, and they got an operational jumpstart. It's an undeniable win for them. But let's shift the focus. What does that high strategic value actually mean for the public minority shareholders?
It means they own a piece of a far more valuable asset.
In theory, yes, but the structure of the deal fundamentally changes the calculus for the public float. We know OSN owns about 70% of that profitable subsidiary, and now WBD is the key strategic partner. The governance risks here are, well, they're immense. Key operational decisions about that subsidiary, resource allocation, reinvestment, pricing, they're all going to be made to benefit the two large strategic partners. The minority public float is effectively locked out of controlling or directly benefiting from those decisions. So that means accessibility to that underlying, theoretically higher value is frankly severely compromised.
I appreciate the governance risk you're raising. It's certainly a material point for any minority shareholder. However, I'd argue the immediacy of securing solvency, of just ensuring the company continues to exist, entirely trumps that long-term governance concern. I mean, we were facing a going concern issue just a few weeks ago. Now we have capital.
Which brings us directly back to the cash flow issue. We can't just dismiss a $37.1 million net loss in the first half of 2025 by saying the $57 million injection solves the problem. It only buys time. If we run that $37.1 million annual loss forward, the capital injection only gives them roughly 18 to 20 months of runway before they are forced to raise capital again, most likely through further highly dilutive means. The fundamental question remains, can ANGH dramatically reduce that burn rate and reach free cash flow neutrality within that very limited window?
I'm not convinced by that line of reasoning because it ignores the nature of the spending. That short-term loss is not a sign of some fundamental structural failure. It's the necessary, aggressive cost of market consolidation. A substantial portion of that loss is attributable to one-time integration costs from merging the OSN Plus platform and ANGH's operations. Those are non-recurring expenses designed to create future efficiencies.
And what about the ongoing marketing cost?
High customer acquisition cost, or CAC, which drove up that net loss, is the direct result of their operational success. They doubled the subscriber base to 3.54 million. In the streaming industry, high upfront CAC is a temporary cost that fuels long-term lifetime value, or LTV. If their churn stays low, that subscriber doubling is incredibly profitable over the long term. And moreover, we have to emphasize the quality of the revenue. 43 million, or 89% of their total, is subscription revenue. That metric indicates a robust, high-quality, recurring operational base now that the merger is done.
It's high-quality revenue that is, at the moment, being consumed by high costs of integration and marketing. The market has to trust that they can flip that switch from aggressive growth spending to operational leverage before the clock runs out on that WBD capital. Now, let's pivot to the mechanical side of this price action, because I believe the exuberance we saw is really rooted in structural instability, not just fundamental validation.
I disagree that the mechanics were purely artificial. I mean, if we look at the technical setup, the stock was deeply oversold. It had an RSI near 31.66, which created a coiled spring just waiting for a catalyst. The massive volume spike was the confirmation that real capital was flowing in and triggering the move. Algorithmic traders and institutional money managers who follow these signals are now focused on the key long-term resistance level, the 200-day moving average, which is sitting at approximately $4.24. Crossing that psychological and technical barrier will signal a definitive trend reversal.
That's an interesting point, though I would frame the trading activity differently. When you're dealing with a stock this thinly traded, average volume of only 20,000 shares a day, we have to correctly interpret what happened. It was a liquidity vacuum. Suddenly there was this massive spike in buy orders, and because the float is so small and liquidity providers, the wholesalers, had no shares to internalize and sell, they were just forced to rapidly lift the offer price to find sellers.
That makes the move clean, though. It wasn't fueled by some messy short squeeze.
It is cleaner appreciation, yes, but it's structurally unstable because of the illiquidity. I'm sorry, but I just don't buy that the $4.24 moving average is the primary threat here. The far greater, more fundamental threat is the guaranteed future supply overhang created by the convertible note program we already discussed.
You're referring to the 22 million shares at $250. Can you just clarify why that creates such a strong ceiling?
Absolutely. Think of that $2.50 strike price as a massive supply floodgate. The convertible note holders OSN group can convert their debt into 22 million shares. That is a massive amount of new supply compared to the current float. So, as the stock price approaches $2.50, and certainly as it moves toward $3, those note holders have a guaranteed risk-free profit incentive to convert the note and sell those shares into the market. This creates a relentless structural supply pressure that acts as an effective price cap, dampening any sustained upward momentum above, say, the lower $3 range.
I see why you think that, but the fact that the stock surged all the way to $350 suggests the market right now believes the strategic value outweighs that immediate dilution threat. The market is betting that the $190 million valuation floor is so firm that it can absorb those 22 million shares and still continue to appreciate toward its true intrinsic value.
It might absorb it, sure, but it will be a painful process of consolidation and volatility. The combination of a low float market structure and a known supply risk makes this stock an inherently unstable vehicle. Even if the underlying business has fundamentally improved, you just cannot ignore that volatility in market structure when you're advising on sustainability.
Well, that's the perpetual dilemma of a microcap turnaround play in an emerging market, isn't it? The need for transformative capital always comes with inherent dilution risk. It's a trade-off.
And it's the public shareholder who, through no fault of their own, bears the brunt of having to manage that trade-off.
So to summarize my position, the WBD deal is transformative. It provides the essential content moat, the exclusive HBO and Max originals, and the capital runway ANGH needs for its super app ambition to really consolidate dominance in the MENA market. While, yes, structural market risks and geopolitical volatility persist, the massive strategic validation and that undeniable $190 million implied valuation floor suggest the public market price is still fundamentally underpriced. For investors watching this, the focus should be on whether sustained volume can push the stock past that $4.24 200-day moving average.
That's a compelling argument, but it's based on future potential, and we cannot overlook the tangible, immediate financial risks. The high cash burn, a $37.1 million loss in just 6 months, and the impending flood of dilution from 22 million convertible shares, these represent concrete financial threats that public shareholders just cannot ignore. The structural challenges of a low-float stock combined with the macro risks of currency devaluation mean this turnaround story is extremely high-risk, high-reward. So despite the undeniable strategic merits of the WBD partnership, the recent price action must be viewed with extreme caution until that $2.50 supply ceiling is definitively broken through and sustained.
It's clear that the material presents a profoundly complex, really a dual-sided picture. On one hand, the company has secured financial survival for the immediate future, and it's gained powerful strategic validation.
But on the other hand, the path to sustained profitability and generating predictable shareholder return remains highly volatile. It's navigating structural dilution risks and a race against that cash runway clock. Our listeners have to weigh that strategic value against the substantial execution and financial risks that still loom very large.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.